My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job, not just to educate, but to teach. Tell you about how days like they come about. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. All right, what happens? What happens if they have a monster rally and no one even knows how it happened? I mean, can't be interest rates. They went higher today. Can't be earnings. Oh, we had some monumental blow-ups in technology. Can't be the dollar. Headed in the wrong direction. But the market roared anyway, with the Dow surging 828.52 points, S&P soaring 2.46%, and the Nasdaq pole vaulting 2.87%. Whoa! You know what?
House of pleasure.
I think there's a growing recognition. This is what's really doing it. It's none of those little niggling things. I think there's growing recognition that the Fed's aggressive rate hikes are finally working. They're paying off. Jay Powell's winning the show. Business is slowing everywhere. Housing, autos, data centers, retail. Prices are coming down for your house. We're seeing layoffs all over the place. You might think these are all negatives, but we're in a bad news is good news moment because the Fed needs to see bad news before they'll take their jackboots off our necks. Stocks are rallying because Wall Street finally believes we're getting closer to the end of this nasty tightening cycle. That's why I have told you from the beginning to stay the course, because I wanted you to be able to capture these short moments, these ones where it all occurs, just like this. You might assume it's easy to know when these tightening cycles are over, so you can get right back in when they happen, especially when you're someone who, like me, has been through a number of them. You figure, like, okay, today's the day. In reality, though, it is a total darkest before the dawn situation. You have to ask yourself, what would the darkest moment look like long before that moment occurs? This time, the darkest moment's looking like the collapse of the big tech behemoths. And that's exactly what happened this week. You got a growing coalition of weaker macro numbers, along with the comeuppance of the once invincible Microsoft, Alphabet, Amazon, not to mention the total annihilation of Meta platforms. The timing certainly feels right for the end of the Fed rate hike cycle after that, doesn't it? We have the Fed meeting next Wednesday, which when we fully expect them to raise rates by another 75 basis points, that would be a sign that the Fed means business. Oh, we want them to do that. We want the means business thing. But then I think the Fed will have to say, you know what, we're going to have to wait and see. And but you know what, by the way, they won't have to wait and see long. You know why? Because on Friday, we have the non-farm payroll reports. You know, I think that's the most important number each month. And I bet it will show, yes, demonstrably weaker numbers than anyone expects. Why are so many people buying stocks ahead of time rather than waiting for this to play out, play a little safer? Simple. You can't dally. History says it doesn't work. History says if you wait for the all-clear signal, you will be too late, and you'll miss not some of the move, but the bulk of the move. Instead, you have to wait until the last remaining members of the market's old leadership get cut down, and that's your chance. The window opened when Meta got clocked yesterday, and it'll close next Friday when we get those employment numbers, especially if they're weak, which will be the sign that the Fed can stop tightening or at least tighten less aggressively. I know this is a lot to get your head around, but it may be one, and it could be one giant false alarm. But in my experience, what you saw this week is exactly the way it has played out for every Fed tightening cycle I have been involved in since 1982. I think the actual darkest moment was this very morning when Apple was bleeding, lying all over the floor, Amazon bent, spindled, mutilated in the corner. thrashings came right on top of Microsoft's meltdown, Alphabet's transformation into a boring cyclical business fully hostage to traditional advertising like some sort of fish wrap evening newspaper, and Meta going completely rogue on us, with Mark Zuckerberg's leadership finally taking what I can only describe as a distinctly Nixonian turn. Nixon was bad. These are the stocks that led the market's rise from the ashes of the Great Recession, and they collapsed all at once. You simply can't get a new business cycle, a new expansion, with new leaders until the old leaders have been taken out and given you a St. Valentine's Day master firing squad. Veteran investors see all these pieces falling into place, and they decide to bet the Fed will declare victory because they've seen this story before. I've seen this story before. I've seen it before. And that's why I'm telling it to you. Of course, that doesn't mean that we need to abandon individual stock picking. That's wrong. It does mean that we need to stay true to form, though. For example, on Monday, NXP Semiconductors reports they've got a ton of auto business. Now, what do we want to say? We want to say, wow, the business is great. Can't wait. No! They need to tell us that business has slowed, in some cases dramatically, and that their forecast has to be cut because, of course, bad news is good news from the Fed's perspective. Tuesday morning, new leadership, Eli Lilly. And in this market, the healthcare stocks are kings because that's what you buy when the economy slows down. Lilly now has a chance to show how it can shine with a fabulous diabetes drug. I want them to keep expectations low, though, and I bet they'll do that. They're really good at that. They're really good. I like that company. Now, we're going to get results from Uber. And again, we need some real bad news here. Something like Uber has economic sensitivity. What does the Fed want to hear? Well, they want to say, you know what? After a long time of not being able to pay enough drivers, now we have too many drivers. They're everywhere, but now we don't have any passengers. They can't afford it. That's what you want to hear. They want to hear about cash-strapped consumers not being able to afford Ubers, so that therefore Uber has to cut their forecast. Hey, listen, don't shoot the messenger. That's what the Fed wants. On the other side of the spectrum, we've got Devon Energy, which is doing incredibly well and pays a great dividend. But you don't want to buy the oils when the economy's weakening. This group will now be under pressure because of the worldwide slowdown. We've pulled back from some of the oils for the charitable trust, and you can find this stuff, as you know, by joining the investing club if you want to know more. We still like them, we still own them, but we're no longer big in them. Why? Because we're in a deflationary environment now, and they don't fit. Now, AMD reports, but there won't be that many revelations. Why? Because they already pre-announced the numbers. That said, I'd like to know if Intel CEO Pat Gelsinger was right when he talked about how he was destroying the competition around him. They were taking share. Didn't really mention AMD by name, but management to look bad. Remember, Pat Gelsinger is no longer as nice as he used to, which is why I like him more. Everything Wednesday will be drowned out by the Fed, which is too bad because we have some very attractive companies reporting. Two big healthcare plays, Humana, okay, my healthcare provider, and CVS, which has been going down, not up of late. I think they both have good stories. CVS stock has pulled back rather harshly, though. I fear that CVS is considered a COVID play. Humana is a post-COVID darling. I still think some of the semis may need to implode if this rally is going to continue. And that may include Qualcomm, QCOM, which makes cell phone chips. Although, given how far the stock's already fallen and the fact that it sells at only 9 times earnings, I wouldn't be surprised. Get this. I mean, it's going to be a shock here. I would be surprised if you actually got a guidance cut and the stock went up $5.38. I like to be precise. Thursday, Starbucks reports, and I think it can be a surprise to the upside because it's one of the few companies in the world that's been able to thrive in China during their lockdown phase. Made in China, for China. Numbers are strong here, and I think the new management will come out of the gate hot. How hot? How about hot as taking a triple venti cappuccino with skim wet and throw it in your face? That's hot. We'll also hear from the new economy stocks like PayPal and DoorDash. I think PayPal has a chance to regroup here as their flagging days have probably ended. DoorDash, though, is inviting skepticism. Why? Because people now love going out, and they don't need all their food delivered. DoorDash takes a big chunk of it, by the way. Not the food, the money. Finally, again, we'll be totally informed with the non-farm payroll report, so let me be very specific about what we're looking for. Stable wages. We're not going to see a decline in wages. It's too early. You need to see them stabilize. But we're going to need some layoffs in hot industries, particularly in Silicon Valley. You can't get a reduction in wages until you see many people losing their jobs. But that's what the Fed wants to see. Is the Fed a bunch of heartless Grinches? Nah, Jay's actually trying to do his job and doing it right. And he's winning. And by the way, when this is over, anybody who made fun of him during this period is going to get a very nasty letter from me. The bottom line, this market's trading like next week. We'll see some real signs that the Fed's winning its war on inflation, and they can therefore ease up on the rate hikes going forward. And with the bear turning 1-year-old this month, I wouldn't be surprised at all if the market got it exactly right. I want to go to David in Connecticut. David.
Hey, Jim.
David.
I am a longtime fan, and I'm also a club member, and I'm also a Mets fan. So I'm very, very jealous that your Phillies made it.
Don't be. No, jealousy does not become you. No, I don't like that at all. And I know that, David, one day we'll go to a game together and we'll have a dynamite time. What's happening?
Absolutely. Okay, so I know we're focused on companies that make things and make profits, and I'm on board with that. I do still have a small position in Upstart Holdings. I've been selling it into strength, but still have some left. I'm wondering, is it worth holding on to or just sell it all at a loss?
No, look, it's down 84% for the year. That's pretty punitive, 84%. So my take is this. I think you probably make a couple shekels before this thing then rolls over again. All right, this market's trading like next week. We'll see some real signs that the Fed is winning its war on inflation, as I told you they would, because they always do. And I wouldn't be surprised if the market's got it right this time. Hey, on Mad Money tonight. Do you know what we have Pinterest on? This stock soared today after earnings. So could this just be the beginning of a move for the social media stock? I actually think it will be. Let's check with the CEO. Then, does Columbia Sportswear have what it takes to dress your portfolio for success going into the holiday season? And it's Sorrel. Don't miss my exclusive. And the home builders are caught in the middle of the Fed's tightening. What do you do here? Why don't we check in with Taylor Morrison Home and find out? I'm going to talk to the top brass of the company. You know what? And stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.